Well, hi, everybody. My name's Casey Boland. I'm a wealth advisor with HCM Wealth Advisors and CPAs. I'm joined today by Doug Johnson, who's our senior investment strategist. Doug, lots been going on so far this year. And how about Phyllis first give us an update on what's been happening with the market so far in 2025? We're in the third week of February. It is February 21st. So give us an update.
Yeah, so I mean, market has held on pretty well. You know, through the first 50 days of the year. I think, there's certainly been some surprises. One of those being that international stocks, which have been the bane of a lot of investors' existence for the past 10 to 15 years, are actually leading the way. I think when I looked yesterday, the ACWX US index was up close to 7%. So, beating the S&P right now by a decent margin. And then you have things like small cap, which I think, had a good start to the year. And then it just kind of fizzled out for whatever reason. They, a lot of these assets have kind of gone through fits and starts as the Mag 7 has been the dominant area. But I think even now you're starting to see, I don't know that I'd call it weakness, but some of the other areas of the market are starting to participate a little bit more. And I think that's probably a good sign, as I don't know that we can continue with the levels of concentration that we've had, and see this bull market, continue to go.
Yeah, it's good to see more breadth in the market, and so that's been a welcome sign, even if that has resulted in foreign doing well. But we've had things like tariff talk, deep seek, so potential issues then with potential spending in AI. So there's been a number of things that have cropped up so far, but it just doesn't seem like it's really tripped up the market yet.
No, and I don't know if I'm stealing this from somebody, but I remember hearing that when you're in a bull market when stocks won't go down on bad news, and you're in a bear market when they won't go up on good news. You had that, you had the CPI report come out, the most recent one, and it was much higher than I think people expected. And initially, the market did sell off fairly aggressively, but it only lasted for a day or two, and then we were back to all-time highs earlier this week. So, the market seems very resilient. It seems like it's shaking a lot of things off. Another thing that I would point out too is that I think a lot of people are expecting this to slow down just because it's been going on for 2 years. And if you look at the history of bull markets, they average, around 5 years. And I think I'm going to maybe butcher the number, but I think the last 7 bull markets have also averaged a return of right around 288%.
Wow.
We right now, I think, are up 88% over the past 2 years. So from a length perspective, this bull market could still be considered very young, and from a return perspective. So, not to say that there's not risks out there, but I think there's also a tremendous amount of pessimism. And bull markets usually don't end because people are pessimistic. They end because there's too much optimism.
Well said. And I think one of the things that you mentioned earlier when we're talking about tariffs, we're talking about inflation. Let's chat a few minutes regarding inflation. Inflation certainly came in a little bit hotter than people expected. And then on top of that, there is a discussion potentially of tariffs. Some have gone into place. Some seems to now have been on the put on hold for a period of time. But we're seeing inflation crop up a bit. So on the inflation front, what do we expect then that may happen? How will corporations deal with the inflation risks with higher costs potentially?
Well, it's a good question. I think there's a few different ways that they can deal with it. One, obviously, their input costs go up. So they're either going to absorb that, and that's going to result in lower earnings, or they're going to pass that along to the consumer by means of higher prices. We just went through a period of high inflation, from, we'll say, the middle of 21 And I guess you can say it's still going on right now. And earnings have been pretty strong the whole time. So you can, I guess, naturally conclude that a lot of that stuff has been passed to the consumer. And let me just share my screen here real quick, and we can look at look at a chart here that'll show this a little bit
Sure.
better. Yeah. So Casey, you sent me this earlier. You want to go ahead and kind of walk through us?
Yeah, so if you look at this particular chart, it's looking at the transcripts of earnings reports by companies and the mentions of inflation to get a perspective of how companies may treat that and how are they going to handle those inflationary expenses. And the observation is that we're going to see an uptick, potentially them passing on those costs. We saw that after the 2020 with COVID, and we had a really rough bout with inflation at that point in time. So we saw a big spike in costs, and those were passed on to the consumer. And fortunately, consumer was in a good position to be able to absorb those costs that got passed on, and you saw profit margins just skyrocket. And this is what's being mentioned again, is that likely they're going to be passed on. It seems like right now, the individual, you look at consumers, you look at business, they're in a very good position to be able to absorb that. But we'll have to see how long can they absorb that, and to what degree potentially could that have an impact on earnings? Because ultimately, one of the things we're going to talk about is earnings. If you're going to look at one factor, earnings is the bottom line driver of where stock prices will go. And we have to see what type of impact this certainly could have.
Yeah, I think that the two main themes through the end of the year are obviously inflation and earnings. The inflation part for all the reasons you just mentioned, and the fact that that's going to drive yields higher, and ultimately, um, you know, stocks can handle higher yields. I think it's the pace of the increase that can give them some problems. But the 10-year Treasury is kind of settled in right around 4.5 right now. So I don't think that's a huge issue. But if we do see an uptick again in inflation or reacceleration of inflation for whatever reason, whether it's tariffs or something else, I think that will certainly cause some issues. Now, you mentioned earnings. I think let's start with valuations first.
Sure.
There's still this wide discrepancy in terms of where different valuations are based on how large a company is in terms of market cap in the S&P 500. So if you go all the way to the left here, you can see that the top 10 names have an average price to earnings of 30.7 times. That's a big number. It's much higher than historical averages. Many people would consider that quote unquote extremely overvalued. Now, valuation is not a good timing tool, but what it does tell you historically is that your returns going forward are going to be below average when you're looking at that starting point. But then you go all the way to the right, and you've got the bottom 100 stocks, 400 to 500, trading in around 16 times, which, quite frankly, is pretty reasonable. And I think pairing that with some of the earnings projections that we've seen, you're starting to see the recipe for some good things to happen. You just haven't had the price of some of those smaller stocks cooperate.
If we start to see PEs then start to expand, then certainly you could start to see prices even go up more. One thing we talked about at our last webinar back in early January is PEs actually, when we look at the S&P 500, are lower today than where they were back during 2021 after a big market run, which is hard to believe. So valuations are at a reasonable spot at this point. So I think between economic landscape, economic growth has been reasonable. The employment situation's been solid. Yeah, valuations are reasonable. And then let's now then shift to earnings. So about 80% of companies have reported so far for Q4 of last year. What's been the picture so far for earnings?
Well, as I looked at the FactSet Earnings Insight report before I hopped on here, as you mentioned, we've got about 80% of companies reporting. The blended earnings number is right around 16%, which
That's a huge
it
number.
is. It would be the highest since Q4 of 2021.
Wow.
And the projections going forward, for both 25 and 26 full year are seeing double digits. Now, what I will say is some of the revisions have moved it lower.
Yep.
I think we've gone from a peak of around 14% this year with expectations around 10 now. But I mean, 10% earnings growth, I think most people are going to take that, happily take it. So I think if you're getting significant revisions down in the low single digits, then you could run into some issues. But I feel like there's always revisions lower. Wall Street's very good at setting a target, revising it lower, 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 lower. Company reports, they beat the last revision. Everyone's, they beat earnings. When you look, and they actually didn't beat the originals, but we don't need to get into that today. But just from this chart here, you can see that both for the Mag 7 and the other 493 companies in the S&P 500, you've got double-digit earnings growth for both. And you actually see the Mag 7 earnings coming down a little bit in terms of
Yep.
the growth rate. It's still a very high absolute number, but the trajectory of the growth is actually going down. And then you've got everything else increasing slightly. But you see that gap starting to close a little bit. And I think, strategists are expecting that to continue through this year. And we've talked about this before. I wonder if this will be the thing that finally breaks the stranglehold that the Mag 7 has over the S&P 500.
Yeah, I think it's important, and a lot of people are probably seeing this chart, but a lot of the things that Doug's referencing, if you look at 2023 to 2024, this last year, the Mag 7, which is going to be that navy blue slice, earnings grew, boy, just shy of 35%, which is a huge year. And then the other 493 stocks only growing 3 or just under 3%. And now the next 2 years, the other 493 growing about 12% or 12% plus. And as you said, then the Mag 7 are slowing some, but you've got solid earnings growth across the board. And revisions likely will come down. I don't know if some companies with the risk of tariffs are taking liberties to bring those down a little bit because of that. But the outlook, though, for earnings is still very strong. And if there's one factor that really is going to be the driver, likely, of what's going to happen with stock prices, it's earnings growth. And fortunately, we come into 2025 in a strong position on a lot of fronts. The consumer is in a good position. Businesses are in a good position. So I think if we do have some crop ups in inflation, we do have some tariff issues, we may be able to absorb some of those things, but only so much. And that's the hard part. We're driving right now with not a lot of clarity about what's going to happen on policy. And so we're going to have to, I think, we can only see so far down that highway, and just take those mile markers as we come to see if the picture changes.
Yeah, I mean, we are entering a period of the year that has historically been a little bit choppy, so it would not surprise me in the least to see a little bit of volatility, whether it's a 5 to 10% correction. I think that would be completely normal. But I do think it's important to remember that our job isn't necessarily to predict the future; it's to react
Right.
to the present. And while there are certainly a lot of things that you could be worried about right now, there are also a lot of things that you should not be worried about. So I think from a portfolio perspective, we're maintaining our overweight equity position right now. And if anything changes there, we'll make the adjustments as needed. But for now, I think that there's enough good news. The market has been resilient enough that we can continue to see this this move higher throughout the year.
Well, we'll keep everyone posted as the year plays out. We appreciate everyone being here for the update. Thank you for the trust and confidence you've placed in HCM. Please don't hesitate to reach out if you'd like to discuss. You have questions about this particular webinar, you want to discuss your individual plan, we're glad to help. And if there's a family member, friend that we can be of service to, please don't hesitate to reach out and provide an introduction. We would be honored. Thank you.